Hello and welcome to Quilter Cheviot's Market Uncut podcast, your review of the week just gone in markets and an inside look into the topics that we've been discussing this week at Quilter Cheviot. I'm Anthony Webb, investment manager on our managed portfolio service, and today I'm joined by podcast regular Richard Carter, our head of fixed interest research, and Ben Barringer, our equity analyst covering technology and media stocks. Good morning to you both. So last week, the great and the good from the worlds of business and politics converged on Davos for the World Economic Forum, during which we heard mixed news on inflation, guidance from the ECB about when to expect rate cuts, and we saw tech stocks led by semiconductor companies pushing the US market to all-time highs, exceeding the previous high set back in January 2022 before inflation wreaked havoc on equity and bond markets. So Richard, coming to you first. We had weakness in the gilt market last week off the back of UK inflation data, with December's CPI print at a 4% annual rate, up from 3.9 in November. Not a huge move by any means, but it ran contrary to the expectation that inflation is slowing, and it pulled back some of that optimism for the early rate cuts in 2024. We've heard you say that maybe markets got a little bit ahead of themselves into the tail end of 2023. So where does the consensus forecast for rates in the UK and the US sit after last week's moves? And do you think we're now in a more realistic position?
Yeah, Anthony, I think we are in a more realistic position. We certainly did get a little bit ahead of ourselves, I think, last year, expecting rates to come down, quite so much as they had been priced to do. I think so. Now you've got a situation where in the US, we're expecting rates to come down about 1.25%. There's sort of hope that we're going to rate cut from the Fed in March seems now to sort of be slowly evaporating, and then markets are also expecting rates to come down by around 1% in the UK as the year goes on. So yes, I think slightly more realistic. Bonds, obviously, off the back of that, have not had a great start to the year because we saw a big drop in yields in the last year, and that's basically now reversed. So we're kind of back to where we were 1 month ago, and I think as far as central bankers are concerned, they are desperate to make sure that they don't cut rates too early. They want to make sure inflation has been at least defeated or got back to sort of 2 to 3% target. So I wouldn't be surprised if we continue to hear them sound fairly hawkish over the next few weeks. But surely, if the data does ease and inflation does keep coming down, then they will get round to cutting rates as the year goes on.
Yeah, absolutely. Yeah, we also heard from Christine Lagarde from the ECB pushing back expectations for European rate cuts to some point over the summer. I thought it was interesting to hear from the Deputy Managing Director of the IMF, again at Davos, warning central banks that this kind of over-optimistic expectation of rate cuts was actually making it harder for interest rate policy to achieve disinflation. So the idea being that, as markets price in lower interest rates in the future, mortgage rates and borrowing costs fall and liquidity conditions effectively loosen rather than tighten. So Richard, a central bank's going to struggle with that kind of final yard of getting inflation down to 2% if markets keep expecting interest rates to fall in the following months.
Yeah, there is a risk of that. It's quite interesting, really, isn't it? The more optimistic markets become on these things, the more central bankers have to push back against them because they're like you say, raising the risk that inflation doesn't come down as expected because like you say, mortgage rates start to come down and financial conditions ease. So as I say, that is why central bankers probably will remain hawkish until they're absolutely sure the job is done. I mean, I don't think you could just say that's the only thing really going on. I mean, you've obviously got pretty tight labour markets here, and particularly in the US, that's pushing wages up. That's less affected, I think, by the sort of weekly rise and fall in sort of bond yields and interest rate expectations, but is another reason why central bank policy's got to stay fairly tight until labour markets weaken. You've also got these things that come out slightly out of nowhere. For example, like the sort of issues in the Red Sea, around Yemen that could cause some supply issues, could increase shipping costs and all the rest of it. That's pretty much outside of the control of central bankers and won't be affected by whatever interest rates are in the UK. But for sure, I think we're going to continue to hear those central bankers push back on market expectations until they think the job is done.
Yeah, absolutely, Richard. There's some geopolitical risks on the horizon, but I think everyone's been surprised at the resilience of economic growth more broadly, particularly in the UK and the US. One quote from Davos that made me chuckle was from Christian Lindner, the German finance minister, who described Germany as not the sick man, but the tired man of Europe in need of a strong cup of coffee. Now, as it's Monday morning and we're recording this, so that metaphor did resonate. But he was referring, of course, to the German economy falling 0.3% last year, and the fact that most expectations for German economic growth are weak and possibly even negative for the year ahead. So, Richard, why is Germany and Europe struggling so much with regards to growth when it's so resilient in the UK and in the US?
Well, I think a lot of his sort of tired man kind of shtick was around the need for sort of structural reforms in Germany and Europe, which obviously him and his government are trying to push through at the moment. I mean, it's interesting you said resilient growth in the UK and US. I'd say yes in the US. UK a bit less so. I mean, okay, we're not in recession, but the latest numbers we've had out in the UK were not brilliant, particularly sort of retail sales and things. So although we're not in recession at the moment, it's possible we may get there at some point. I mean, I think the difference, particularly with Europe versus the US, is that Europe was more affected by the energy crisis, kind of post the whole Ukraine thing. There's been a lot less government stimulus as well, particularly in Germany. And then you've also had some of their manufacturing sectors affected by what's been going on, slower growth in China. So Europe, Germany in particular, they are struggling a little bit, which is why I suspect the pressure will build as the year goes on for the ECB to cut interest rates.
Thanks, Richard. So not quite out of the woods yet for the UK economy. But turning to equity markets, US equities closed last week at all-time highs, driven higher at the end of last year by those falling interest rate expectations. But gains in 2024 have been largely a return to strength from tech stocks, and in particular, semiconductor companies have been performing very well. Nvidia is up 20% so far this year. AMD also up around 18% year to date, and TSMC up 10%. So Ben, turning to you, TSMC reported earnings last week. Was there anything in their results to support these gains that we've seen so far this year?
Yeah, morning, Anthony. Yeah, absolutely there was. I think I would highlight three things from TSMC's results last week. The first one is the guide for 2024, which is above expectation at 20 to 25% growth after a flat year in 2023. And that's really driven by a recovery in the PC market, but also more importantly, data center and AI chip manufacturing really accelerating, continuing to grow very strongly. They said that high performance compute would grow faster than that 20 to 25%. And remember that TSMC makes the chips for Nvidia and for AMD. Interesting to note as well, though, that smartphones is going to grow lower than that growth rate. And so, that's not great for Apple. So that's the first thing, the better guide. The second thing is that they continue to have a large capex budget, 28 to 32 billion. That's actually flat on 2023, but it shows the continued confidence they have in the demand for chips going forward. They also talked about their transition to the next node, 2 nanometer. And so that's, again, positive for the semicap equipment stocks like ASML. And then the third piece, I think, is they not only make chips, but they also package chips for companies like AMD and Nvidia. They use a particular type of advanced packaging called CoWoS, that's chip on wafer on substrate, for these advanced chips. And the capacity for that, their plans doubled in 2023. They are going to double again in 2024, and they're expected to probably continue to grow even in 2025. And so that is a very good indicator for both Nvidia and AMD that the demand for those chips remains very, very strong. Interestingly, TSMC actually underperformed in 2023 compared to certainly the US semiconductor index, and it looks particularly cheap. So yeah, we're pretty constructive on TSMC.
Great, thanks. And some tailwinds there for the wider semiconductor sector as well. I think there was a lot of talk last year, of course, about the Magnificent Seven, of which Nvidia is one. These kind of tech stocks or tech adjacent type stocks that have made huge gains in 2023. Collectively, they doubled in value over the last year or so. And the more they grew, the more concentrated returns seem to become around these bigger and bigger index constituents of the US market. So in 2024 now, despite the economic backdrop so far this year not being perfect, as we discussed with Richard, interest rate expectations have been rising. Yet some of these tech companies seem almost invulnerable to any headwinds. So, what are your thoughts on the Magnificent Seven in general? Do you look at them as a package of big structural growth investments in the US, or maybe some of them less magnificent than others?
Yeah, that's a great question. I mean, I don't like FANG, MFANG, or Magnificent Seven because you're trying to group these businesses together. Yes, they are all large. Yes, they all net cash. Yes, they all will grow better than the market. But underlying all of them are some quite different drivers. I would highlight, however, that despite the macro uncertainty, one of the best macro factors I look at is corporate profitability and, more importantly, IT spending growth. And although IT spending growth has come back from about 4% during COVID to about 2.8%, it looks like it's reasonably stable. In fact, maybe even growing, accelerating back from 2.8 to 3% in 2024. And that underpins some of the spending that's happening by corporates on IT. Obviously, the big areas of spend are move to the cloud, along with sort of digitization. Within that, AI spending, and then also cybersecurity. And those are three things that really underpin a lot of our investments and specific investments in the models in terms of stock selection. Just to go to some of the year-to-date performances, actually, it hasn't been all Magnificent Seven this year. You mentioned Nvidia up 20%, Meta's up 8%, Microsoft up 6%, Google up 5%, but then Amazon only up 2%. Apple flat, actually, and I mentioned those slightly weak smartphone numbers, and then of course Tesla down 14, some not great numbers out of them at the beginning of the year. So it's not all plain sailing. I would also mention, we talked about AMD. That's a great play on this AI growth, but you've also seen companies that we hold like Salesforce and Palo Alto up double digits. And so actually the fact that we've got strong positions in AMD, Palo Alto, Salesforce, and an underweight position in Apple, and also a no position in Tesla, that really helps our performance so far. But it's early days, Anthony, and so we're pleased with our performance so far, but we're only a couple of weeks into the year.
Absolutely, early days. So what do you think, looking forward, what should investors be on the lookout over the coming weeks in the technology sector as we get more earnings updates? And are there any particular concerns or risks that we should be aware of?
Yeah, so we've already had TSMC. This week we've got Netflix, which is widely looked at for the health of streaming video. We expect about 10-12% revenue growth driven by subscriber growth. Also a move. Remember, they are starting to do a ad-supported service, and they're also clamping down on people password sharing. On the periphery, they always get asked about their thoughts on sports as well, and also video games. You'll note that you can now download video games in the Netflix app. So that's all incremental to their growth rate. Other highlights this week are going to be, SAP. That business is going through a cloud transition, has very sticky customers, and also has some new products that are AI enabled. So SAP is an interesting sleeper sort of software business that's benefiting from AI. ASML reports this week, and the big focus will be on, they've had a very strong 2023 driven by particularly China demand, but also some logic, so processor demand. This year, 24, is supposed to be much flatter as Chinese demand falls off, and we're waiting for that TSMC transition from 3 nanometer to 2 nanometer. But then in 2025, that 2 nanometer transition is going to happen, and so growth will re-accelerate for ASML. So that's one to watch. It's got a bit of an air pocket, but I think it's pretty strong. And then the week after this, we're going to have the some of the more of the Magnificent Seven reporting: Microsoft, Google, Amazon, and Meta. And there, to summarize, we're going to be looking at what cloud demand looks like. Within that, what AI demand looks like. Obviously, their CapEx budgets, and then, of course, how they're managing margins. Because one of the big benefits of these Magnificent Seven, these large tech companies, is actually they're very big, but they've actually been very agile on cost, and that's driven tremendous margin profitability and free cash flow upgrades through last year. So, one of the reasons these stocks worked is, one, they're big, and so they are beneficiaries of AI because they've got a lot of data, but also because they are agile and have been able to deliver very substantial free cash flow when other areas of the market have not delivered. In terms of risks, always very important. I always sound very bullish, but it's all about being professionally cynical and what could go wrong for some of these companies. IT spending we watch very closely and making sure that is not deteriorating. I think there are some very high expectations, and let's make sure that those expectations are either meet or beaten. And then the other area that I always look at is what other sectors could take over from the leadership of the market. If IT fundamentals start to roll over, but maybe oils or financials or energy comes back into the fore, then that could lead to some tech underperformance. But so far so good. But we're early days, as they say. Thanks.
Great, thank you, Ben, and thank you, Richard, as well. Some fantastic insights there, and great to hear from Ben those pockets of opportunity for investors, despite perhaps a slowing economic backdrop in the UK and Europe. So hopefully some food for thought for our listeners. Thank you to our listeners for tuning in. If today's podcast has prompted any questions that you'd like to put to Richard or any other member of the research team, please do get in touch. You can click the Contact Us button on the weekly comments page on our website, www.quiltercheviot.com. We'd love to hear from you. And remember, so that you don't miss any future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following #QC Weekly Comment on LinkedIn. Thanks again for listening. Goodbye.